After the 2020 pandemic, with loose monetary policies and the shifting of supply chains, we have witnessed a significant surge in prices. In this context, wealth has been quietly redistributed across society. Gold, as a key indicator of wealth, has played an important role in this redistribution. As of September 2024, gold prices have been steadily rising. But has this current surge reached its peak, or is there more room for further increases? What is the underlying market logic driving these movements? In the following discussion, I will explore these questions from a different perspective. Gold, unlike many other assets, does not generate cash flow, which often makes it challenging to value. However, by examining historical gold price patterns and the corresponding economic environments, we can uncover hidden valuation principles in the market. I will discuss two valuation models that I believe offer effective insights into gold prices and share a simple, practical method for gauging whether gold is over or undervalued. Of course, the future is inherently uncertain, and markets may not always follow these logical patterns. Nevertheless, I hope these frameworks can provide a fresh perspective on gold investment. To fully grasp the logic behind gold's valuation, it is essential to first understand the fundamentals of the gold market. I will briefly outline the key players in the gold market, the changes in gold holdings by major central banks, and the views of prominent investors like Warren Buffett and Ray Dalio on gold. Afterward, I will evaluate gold's true potential as a store of value before introducing valuation models that I believe align with market trends. I will show how these models can help assess gold's price levels. Disclaimer: the gold prices and trends presented in this video do not represent future gold prices or trends. All models are provided for reference purposes only and do not constitute investment advice, recommendations, or offers. No liability will be assumed for any losses resulting therefrom. Gold investments carry risk. Please conduct independent analysis and invest prudently. Who is buying gold? According to the World Gold Council's 2023 report, the Earth holds approximately 270,000 metric tons of gold, of which 210,000 tons have already been mined, leaving less than 60,000 tons unmined. All the gold ever mined by humanity could fill 2.8 Olympic-sized swimming pools. Of the gold that has been mined, nearly half is used for jewelry, while over 1/5 is held as investment in the form of gold bars and coins. Additionally, 17% of the world's gold is held by central banks as reserves. In 2023, global gold demand was primarily driven by 2,168 tons used for jewelry, representing 44.2% of total supply, and central bank purchases amounting to 1,037.4 tons, or 21.2% of total supply. The remainder was mainly for investment purposes, such as bars and coins. Given the annual production of 3,644.4 tons of gold in 2023, the estimated 60,000 tons of unmined gold could be fully extracted in just 16 years. Changes in central bank gold holdings. Having reviewed the composition of gold buyers globally, we see that nearly 40% of gold consumption comes from jewelry, with individual consumers as the main purchasers. The other two major buyers are central banks and gold investors. Central bank gold purchases, in particular, have attracted significant market attention. As of 2023, the top 6 central banks holding the most gold are the US, Germany, Italy, France, Russia, and China. Before and after the pandemic, central banks of China, India, Japan, Russia, and Turkey increased their gold reserves significantly, while the top 4 holders, the US, Germany, Italy, and France, saw little change in their reserves. This is because the US dollar and the euro remain the primary reserve currencies for other nations. The main drivers behind the recent central banks' gold demand have been the central banks from non-reserve currency nations. This trend mirrors the actions of Western European countries before the collapse of the Bretton Woods system in 1971. In the 1960s, the world was still under a gold standard tied to the US dollar, but the oversupply of dollars caused dissatisfaction among countries like France and Germany, which held large dollar reserves. These countries began converting their dollar holdings into gold, eventually leading to the decoupling of the dollar from gold. Buffett and Dalio's views on gold. Let's take a look at the perspectives of two influential figures in the investment world, Warren Buffett of Berkshire Hathaway and Ray Dalio of Bridgewater Associates, regarding gold. Buffett famously said that gold is dug out of the ground, melted down into bars, and then buried again, with people paid to guard it. He noted, gold has no utility. On the other hand, Dalio believes that if an investor doesn't own gold, they neither understand history nor economics. Buffett's view on gold is rooted in his investment philosophy, which favors assets that generate cash flow and compound returns over time. He argues that gold produces no income, dividends, or any form of cash flow, and it doesn't contribute directly to the economy. In Buffett's eyes, gold is a non-productive asset, and its value hinges primarily on the belief that someone will buy it at a higher price in the future. Dalio's perspective stands in sharp contrast. In his book, The Changing World Order, Dalio analyzes the rise and fall of global powers throughout history and identifies patterns. He observes that when new empires rise, the currencies of declining empires tend to devalue, eroding purchasing power. During these transitional periods between old and emerging powers, gold, unlike depreciating fiat currencies, has historically maintained its value and acted as a reliable store of wealth. In major global crises and wars, fiat currencies have often lost significant value relative to gold. According to Dalio, during these periods of world order shifts, gold consistently protects against the depreciation of fiat currencies. Looking at Dalio's macro-historical perspective, Buffett's investment experience has occurred during the upward phase of the economic cycle. Buffett himself has said he was fortunate to be born in a prosperous America rather than in an underdeveloped region, and that he benefited from America's post-war economic boom. However, if the U.S., the world's leading power, begins to decline or stagnate, Dalio's view suggests that gold could serve as a hedge against the weakening of the U.S. dollar. When comparing Buffett and Dalio's views, it becomes clear that Buffett views gold in relation to capital, focusing on returns and the compounding effect of productive assets. Dalio, on the other hand, compares gold to currency, paying attention to historical cycles of power shifts and the inflation risks caused by excessive money printing. While both capital and currency relate to wealth, they are fundamentally different. In times of societal stability, capital grows and creates wealth, whereas currency's primary function is as a medium of exchange, whose purchasing power fluctuates based on economic conditions. Clearly, Buffett and Dalio are looking at gold from different time horizons and viewpoints, and neither view is necessarily superior to the other. So, do you lean more toward Buffett or Dalio's perspective? Can gold preserve wealth? Whenever global uncertainty or market panic arises, capital tends to flow into gold and bonds, often referred to as safe havens. This behavior mirrors how, in times of historical turmoil, people would sell off real estate and convert assets into gold. Investors view gold as a vessel of wealth, believing it can protect against inflation over the long term. But does gold truly preserve wealth, or to what extent can it serve this function? We can make a rough assessment by comparing historical gold price movements with inflation rates. In August 1971, U.S. President Nixon announced the end of the gold standard, decoupling the dollar from gold. Since then, gold prices have been determined by market forces. From August 1971 to April 2024, the U.S. Consumer Price Index, CPI, increased by 7.7 times, while gold prices surged nearly 60-fold during the same period. However, it's important to note that part of gold's sharp rise was due to its initially low price when the dollar was first decoupled from gold. If we instead measure from December 1991, when gold prices were more stable, to April 2024, inflation increased 2.3 times, while gold prices grew by over 6 times. Over the long term, gold has indeed shown the ability to preserve wealth and even appreciate in value. However, it's important to note that if you purchase gold during a price peak, there may be periods where gold does not keep up with inflation. This leads us to the next point. How can we determine whether gold prices are high or low? Additionally, if we compare the performance of the S&P 500 over the same period, the index has risen by more than 12 times. While gold has often outpaced inflation, It has not kept up with the growth of the S&P 500 to date.